Welcome to today's video on optimizing your retirement savings using the tax code more intelligently. We will unpack traditional versus Roth 401ks, why the difference matters, and how progressive tax brackets shape the best choice. We will also introduce a practical framework to decide, walk through a numeric example, and finish with key takeaways. Let's begin. And then we'll gradually build toward a clear decision flow. First, we will clarify why taxes drive this decision. Next, we will compare traditional and Roth options. Then, we will explain the progressive tax system and apply it to a concrete example. After that, we will review a decision flowchart and a simple 5-step process. We will also discuss a hybrid contribution approach, consider RMDs and long-term implications, and finish with a short quiz and concise summary. Here is the central idea. If you are in a higher tax bracket now than you expect to be in retirement, deferring tax with a traditional 401k often optimizes lifetime tax efficiency. You get a deduction at today's higher rate and pay taxes later at a lower expected rate. Conversely, if your current income is low and likely to jump significantly, paying tax now with a Roth can be attractive. The key is to align contributions with your current and expected future tax brackets. To set the foundation, remember that the U.S. tax system is progressive. Portions of your income fall into different brackets, and only the amount within each bracket is taxed at that bracket's rate. A traditional 401k reduces your taxable income today and taxes you later in retirement when you withdraw funds. A Roth 401k taxes your contribution now, but allows tax-free qualified withdrawals later. The primary decision lever is your current marginal tax rate compared to your expected retirement marginal rate. When evaluating, focus on your lifetime effective tax rate, not just a single year. Let's run a simple, isolated tax example. Suppose you can contribute $10,000, and your current marginal tax rate is 32%, while your expected retirement marginal tax rate is 22%. With a traditional contribution, you defer the tax. You save $3,200 in tax today. In retirement, when you withdraw $10,000, you pay 22%, or $2,200, leaving $7,800 after tax. With a Roth, you pay the 32% tax today, or $3,200, but withdrawals are tax-free later. In this setup, the traditional approach results in a smaller total tax burden, because you moved income from a higher tax year to a lower tax year. If the rates reverse, the conclusion can flip in favor of Roth. This illustrates how sensitive the choice is to your current and expected future marginal rates. Let us compare. Traditional 401k provides an upfront deduction, defers taxes, and taxes withdrawals in retirement. It can also help reduce current adjusted gross income and preserve eligibility for certain tax benefits. Traditional accounts are generally subject to required minimum distributions beginning at age 73, subject to legislative change. By contrast, Roth 401k contributions receive no deduction, but growth and qualified withdrawals are tax-free. As of 2024, Roth accounts and employer plans are not subject to required minimum distributions, and Roth IRAs have never had RMDs for the original owner. Roth can be helpful when you are currently in a low bracket and expect higher brackets later. Both contribute to tax diversification and flexibility. This flowchart begins with the core comparison between your current marginal tax rate and your expected retirement marginal tax rate. If your current rate is higher than your expected future rate, the flow directs you toward favoring the traditional 401k. If your current rate is lower, it points toward the Roth 401k. If rates are roughly equal, it suggests a blended approach. Additional decisions consider whether you need to reduce adjusted gross income to qualify for certain credits and phase-outs, which can tilt the choice toward traditional, and whether you expect outsized earnings growth soon, which can tilt toward Roth. The chart reminds you to reassess annually, because tax laws and your situation can change. Next, here is a 5-step guide. First, identify your current marginal rate and effective rate. Second, estimate retirement income sources and your likely marginal bracket. Third, check whether reducing adjusted gross income today helps you qualify for tax credits, deductions, or avoid phase-outs. Fourth, test both contribution paths with a simple calculator, even if it is a rough model. Fifth, reassess each year since earnings, goals, and tax laws evolve. This stepwise approach keeps your plan aligned with changing circumstances. To keep this video broadly applicable, this table shows common marginal rates at a high level without specific income thresholds, which change over time with inflation adjustments and legislation. Treat this as a conceptual map only, and always verify the current IRS tables for your filing status. Now, consider a hybrid approach. First, favor traditional 401k contributions to capture the upfront deduction when your marginal rate is high. Then, add a Roth IRA for tax-free growth and flexibility. If your income is too high for direct Roth IRA contributions, you may explore backdoor Roth strategies where appropriate and permissible. This diversified approach gives you multiple tax buckets to draw from later. Finally, as your marginal rate changes, you can adjust the contribution mix. This pie chart displays a hypothetical contribution mix: 70% traditional 401k, 20% Roth IRA, and 10% taxable brokerage. The exact percentages are purely illustrative. The intent is to show how you might tilt contributions toward traditional when your current bracket is high, while reserving a portion for Roth and taxable accounts to preserve flexibility and manage future tax exposure. Meanwhile, there are clear cases for the Roth 401k. If you are currently in a very low tax bracket, but expect significant income growth or liquidity events, paying tax now can make sense. If you expect to retire in a higher tax state, or you value tax-free withdrawals to manage Medicare income-related monthly adjustment amounts, or the taxation of Social Security benefits, Roth can help. Additionally, some want to hedge against potential future tax increases. Finally, plans that permit after-tax contributions and in-plan Roth conversions can enable advanced strategies often called mega backdoor Roth. This timeline shows how tax-aware contribution choices can evolve throughout a career. In early career, when brackets are often low, Roth may be favored. During mid-career, as income rises, a blended approach can balance benefits. At peak earnings, the traditional 401k often becomes more appealing due to the larger deduction at a high marginal rate. In retirement, you can manage withdrawals across tax buckets and consider partial Roth conversions from pre-tax accounts while accounting for RMDs and other constraints. Reassessment each year keeps the plan aligned with current laws and objectives. Quiz time. The question asks, which account type is likely most efficient when the current marginal tax rate is 35% and the expected retirement marginal rate is between 22 and 24%? The options are A. Roth 401k, B. Traditional 401k, C. Split contributions 50-50, or D. Taxable brokerage only. You may pause the video now to think about your answer. We will discuss the answer in the next section of the video. The correct answer is B. Traditional 401k. In this scenario, deferring income from a 35% year into a future year, taxed at approximately 22 to 24%, generally reduces your lifetime tax burden, assuming all else equal. Looking ahead, required minimum distributions apply to most pre-tax accounts beginning at age 73 under current law, though rules can change. As of 2024, Roth 401ks are not subject to RMDs, and Roth IRAs have never had RMDs for the original owner. Strategic partial Roth conversions during lower income years before RMD age can reduce future required distributions and manage lifetime taxes. Coordinating withdrawals across multiple account types can help control taxable income, Medicare premium surcharges, and Social Security taxation. Because laws evolve, an annual review with a qualified professional is prudent. The key points are as follows. First, align the account type with your marginal rates. When your current rate exceeds your expected retirement rate, traditional is often favored. When the reverse is true, Roth can be better. Second, the progressive system makes the timing of tax powerful. Third, a hybrid approach can capture current deductions and future flexibility. Fourth, reassess annually. Fifth, plan for RMDs and evaluate partial Roth conversions when appropriate. In summary, let your current and expected future marginal tax rates guide your choice. Consider adjusted gross income side effects, such as credits and phase-outs, when optimizing current year taxes. Blending strategies can provide tax diversification and smoother retirement income planning. Finally, continually reevaluate your assumptions because life and tax laws change. Disclaimer: this content is educational and does not constitute tax, legal, or investment advice. Individual circumstances vary widely. Consult a qualified tax professional or fiduciary financial advisor before taking action. Thank you for watching. If you found this valuable, please like the video, share it with someone planning for retirement, and subscribe for more tax-smart investing content. Share your situation or questions in the comments so we can learn together. See you in the next one.